Hi there. Philip Morris is a business that pays a dividend around 5.5%. If you look at the stock price, it has declined by more than 18% from its peak. If you look at a longer period, you will see that the stock price has been around $90. And of course, the dividend has increased over years. Now, the most important question is if Philip Morris is a buy at the current price. To find that, you have to do a valuation. If you look at revenue and earnings, they are expected to grow more in the future. Analysts expect earnings to increase from 9 billion to 16 billion and revenue from 31 billion to 53 billion. So the future outlook looks great. Now, if you want to value this business, it's better to use their dividends, which are expected to grow more in the future, from $5 to $5.62. It's not that much growth, but it's an improvement. And based on these estimates, we can calculate the fair value. First, let's start with the risk. Based on analyst estimates, the fair value would be around $55 for a 10% return and a multiple 10. And if you compare that to the stock price, you can see that this business is overvalued. Of course, this is the risk. The stock price may decline by 50% if their growth slows or declines. That's why we have to be aware of this risk, or other problems occur in the future. You never know. Now, let's look at the gray scenario, where the multiple is around 20 and the fair value would be around $90 and the stock price is about $91. So based on this scenario, the stock price seems fairly valued for a 10% annual return. Of course, this scenario also depends on interest rates. If rates go above 5%, then this scenario will never happen. That's why you have to be aware of the risk. Now, let's see the normal case, where the multiple is around 15 and the fair value will be around $72. So the stock price is overvalued for a 10% annual return. Now, if you choose a lower return, let's say 5, then the stock price is fairly valued. So it also depends on the return you want from this investment. If you want 10%, then you have to wait for a bigger decline. Now, there are some problems you should be aware of. First, the debt, which is around 40 billion, and as Philip Morris makes around 9 billion in earnings, that debt won't be a problem. But you have to follow this debt. If it grows too much, then you have to be aware of this risk. The second risk is declining smoking rates. As you can see in this picture, smoking rates have been declining for a long time, and they are likely to continue. The less people smoke, the less money they make. And Philip Morris is trying to balance this risk by providing smoke-free products, such as IQOS and ZYN. I'm sure you've seen people around you that have one of these products. And if you look at the user growth, you can see that it keeps growing. In this image, you see their IQOS users. And in the second image, you see the other brand from the US, ZYN, which has amazing growth. So Philips is trying to balance this risk of declining smoking rates by providing smoke-free products. And that's why their revenue and earnings are expected to increase so much, even though the smoking rates are declining. So to sum up, Philip Morris may be fairly valued if everything goes well, but you also have to be aware of the risk and the normal case, where the return is not that great. Your return might be around 5% or higher if the multiple is around 20. So the current price, your return may be around 5%. Now, if interest rates go down, then your return may be even higher, between 5 and 10%. So you have to see for yourself if you can handle this risk. Philip Morris is a stable business. People are addicted to smoking, but you also have to be aware of the price you pay, because if you pay too much, your return won't be that great. That's why you have to be aware of the risk and look at the normal case, or the multiple may be around 15, and the fair value around $72. This would be a return around 10% a year. And if you have any questions, please let me know in the comments.